If you're trying to decide if now is a good time to become a real estate investor, you're in the right place. Now, just for context, I've been investing in real estate for more than a decade now. And back in 2011, when I got started in real estate, it was a very different environment than what it is today. And this is where a lot of people are saying it's impossible to invest in real estate now. But what I can tell you is you're seeing more and more unique investment opportunities starting to pop up, and more will be coming. Don't believe me? Let me show you. Here is a 3-bedroom, 1-bath home listed for sale in a nice and growing population suburb of Detroit in Michigan. Is listed for sale for just under $100,000. I'll blur out the address here for privacy, and just for context, I'm recording this in mid-March 2024. The home is not destroyed. Take a look at the pictures. $20,000 to $30,000 worth of work would make this home amazing, and the rental price for this home, according to Zillow, is $1,550 a month. But if you want to make money in real estate, you kind of got to know what you're doing. I'm telling you from experience because, well, when I started, I had no idea what I was doing. So in this video, I want to break that down by talking about 3 different things. Number 1 is why real estate investing is powerful. You'll understand the different benefits that you can get from real estate, that way you can maximize these benefits. Number 2 is talking about where you can find growing neighborhoods, how you can find good locations. And then number 3 is talking about the numbers. How can you find a deal that's actually making money? How do you run those numbers? So let's start with number 1, talking about why real estate and why real estate is so powerful. And I also want to let you know that on April 2nd, 2024, I'm hosting a live, free, and virtual real estate investing workshop where I'm going to be going over my own real estate investing strategies. I'll be going over some of these topics. I'll be talking about how do you find a good location, but also how do you build a strong real estate investing team to help you with this process, because you want it to be passive for you. How do you actually close the deal? How do you run the numbers and make sure that this deal is going to make you money? And then how do you maximize your profits? This workshop is completely free. It is live and it is virtual. So yes, you will be able to ask questions, but if you want to join, you need to register for this workshop. I got the link for you down in the description below. Just make sure you register soon, because there's a limited number of people that can join me live. Now, in a nutshell, the reason why people love investing their money in real estate is because you can depreciate an appreciating asset that generates cash flow, and you can also get some tax benefits. And I'm not going to spend an hour going over this in this video, but let me go over what this means briefly. Let's assume that you go out and you buy this property for $200,000. What do you think this property is going to be worth 10 years from now, assuming you bought this property in a good location? Now, I'm not a big fan of speculation. I'm not a big fan of flipping, but just for the purposes of this example, what most people would assume is that this home is going to be worth more in the future than it is today. How much? Well, nobody can predict. Is there a chance it'll be worth less? Sure, but the hope is that 10 years from now, maybe this home will be worth, I don't know, $300,000. Again, I am not in the game of trying to predict this. I'm just showing you this as an example. So what is this? This is appreciation. This price growth is appreciation. So if you sell this home for a profit 10 years in the future, this is money you made just for sitting on this property. But while you see this appreciation, you also get depreciation. Let me show you what that is. As a licensed attorney, who's not your attorney, what I can tell you is that the IRS gives you some special tax breaks as a real estate investor. And one of those tax breaks that real estate investors love is called depreciation. So what you do here is, first, you separate the value of the property versus the land. So you bought this property for $200,000. Let's assume that the land that this property is sitting on, the land that this home is sitting on, is worth, I don't know, $20,000. So this building itself, the home, the actual property, is worth $180,000. Well, what the IRS says is you get to write off a piece of the physical property, a piece of this $180,000 every year for the next 27 and a half years, assuming that this is a single family residential home. So what does that mean in practicality? Well, if you take $180,000, the value of the property, you divide that by 27 and a half, that means that you get to take around a $6,500 tax write-off every single year, which brings me to the third reason why investors love investing their money in real estate. You generate cash flow. So let's assume you bought this property for $200,000. I'm going to get into the numbers a little bit later, but let's assume that every year you make $10,000 of profit. This is the money that's in your bank account after paying for your expenses, your property taxes, insurance, your maintenance, your management fees, your mortgage, and everything else. You pay for all of your expenses, and then you have $10,000 in the bank account at the end of the year. Now, normally, when you make $10,000 of profit, you got to pay taxes on $10,000 worth of income. But remember what we just said, depreciation. This is where now what you get to tell the IRS is, hey, my property is 1 year older. And because of this depreciation schedule that I just showed you, you get to take a write-off of $6,500, a little bit more than that, but $6,500, meaning you tell the IRS, hey, I have $10,000 in my bank account, but I'm only going to report $3,500 worth of income. So you have 10 grand in your bank account that you can spend, but you tell the IRS, I only have $3,500 worth of income because this is considered a paper deduction. It's not a real expense, it's just an expense that you show on paper. And now you tell the IRS you only have $3,500 of taxable income, which means you have a lower tax rate. So now you pay taxes on $3,500, but you have $10,000 in the bank. So now you have this appreciation, the value of your property hopefully going up. Number 2 is you have depreciation, this tax write-off that you get against number 3, your cash flow, you're making money every single month. And then we have the 4th benefit, which are your tax benefits. Now when it comes to taxes, what you want to understand is you want to make sure you're playing within the rules, because if you're playing outside of the rules, you can end up in jail. So you want to make sure you have a good tax advisor to help guide you through this process, but the IRS tax code gives you a lot of flexibility as a real estate investor. One of those things is, let's assume now that this property actually goes up in value. I don't like playing this game of trying to sell my property for a profit because nobody can predict what's going to happen here. But let's just assume now with this hypothetical, your property grows to $300,000. What you can do now is if you sell this property for $300,000, you have a $100,000 gain, a $100,000 profit, which normally, again, you got to pay taxes on. But because it's real estate, you get this special kind of tax break which says, hey, if you take all $300,000 and use all this money to go out and buy more investment real estate, that's going to give you more depreciation, that's going to give you more cash flow. Well, now what you can do is you can defer all of those taxes because of something called the 1031 exchange. This is pretty much every real estate investor's favorite tax code because now what you can do is you can buy this property, make money every single month, get this depreciation deduction. If this property grows in value because you bought it in a good area, because the economy grew, well then you can sell this property for a profit, go out and buy more rental real estate that's going to make you more cash flow, more tax write-offs. And you can do this again and again and again until you die and never have to pay a penny in taxes on these capital gains, on the gains from the profits of you selling a property. You can't really do that anywhere else. If you go out and you buy a stock for $1,000 and it grows to $10,000 and you sell the stock for a profit, and then you take all $10,000 and then you buy another stock, you still have to pay taxes on the $9,000 worth of profit. So you don't have the same opportunity in the stock market, but in the real estate game, you can see this growth in real estate value, and then you can sell the property and take all this money and buy more real estate and not have to pay any money in taxes on those gains. Now, in order for this to actually work, you can't spend this $300,000 on a car. You have to actually go out and buy more real estate, but it allows you to grow your real estate portfolio essentially tax-free, because now you can buy this property, see it grow in value, sell it, buy another property, see it grow in value, sell it, and do it again and again and again. You just have to make sure you're actually holding on to the properties for more than a year. You can't be a flipper and doing this. You're not doing this as a real estate fix and flip person. You have to be an actual real estate investor to qualify for this, someone who's buying the property to do this rental game. This brings us to point number 2, which is where do you actually find the good locations to be investing your money? And one of the things that I like to look for is an area where you're seeing growing populations and growing business, because you can really think about this in terms of supply and demand. If you're investing your money into a neighborhood where people are moving out of, where businesses are moving out of, you can find cheaper properties. But if people are moving out, that means there's going to be less demand for your property. Because if the population is shrinking, there's less and less people for a limited number of homes. So if you have 100 homes in this neighborhood and the population is declining year over year over year, well, more and more homes are going to be sitting vacant. And I don't want to be investing my money in an area where this population is shrinking. And this is where now what I like to look for is number 1, where this population growth, and number 2, business growth. And I know what you're going to say, but Jaspreet, how do I find an area where the population's growing and businesses are moving into? Well, there's this amazing real estate investment research tool called Google. And if you put in a neighborhood like Manhattan population, what it will show you is the trends of Manhattan. You can even narrow it down to particular neighborhoods or particular cities in some instances, but just do a quick Google search and you'll see where populations are moving. Now you can dig a little bit deeper. There's other sites out there which will show you population trends in particular neighborhoods. But if you want to see where businesses are moving, go out, get in your car, drive around the neighborhood and walk around the area. Because you're going to see very quickly if there are developments moving in or people are moving out. You'll see if things are being boarded up and businesses are shutting down or if businesses want to move in. It's very clear and easy to tell. Real estate investors sometimes pay thousands of dollars for this data. But one of the best ways to find this information is just to go out and walk it yourself and then do what I like to call the $5 coffee test. Go to a local coffee shop in the neighborhood and talk to the baristas there and ask them this simple question. Do you live in this neighborhood? If so, do you like it? If not, do you want to live here? And now you're going to get thousands of dollars worth of real estate secret data for the price of a cup of coffee. Because now what this barista will tell you is either, no, I don't live here, but I would love to live here. Or they'll say, no, I don't live here and I don't want to live here. Or they're going to say, I live here and I love it. I love going out here. My friends love being here. Such a cool place. Or they're going to say, I live here and I want to get out because the crime is getting worse. And now you got your answer. And go to a few different baristas, go to a few different coffee shops because now you'll kind of get the lay of the land, especially if this is an area you're unfamiliar with. It's a very simple and easy and cost-effective way to really understand, are you investing your money in a good area or not? You can find the population information on Google, then just go out and talk to people, walk around and drive around the neighborhood. I mean, there's really no way around this. If you want to invest your money in real estate, you have to be involved to some extent. You can't be completely passive like the stock market and expect to make money because the real estate is much more involved. There's people involved, there's things involved, and you want to make sure you're actually looking at where you're investing. And this brings us to number 3, understanding the numbers of your real estate deal. Now again, I'm going to be going deeper into this in my real estate investing workshop. I got that link for you down in the description. But to understand the numbers, you got to understand what types of returns that you're looking for. Now I kind of hinted at this earlier, but I'm going to make this very clear now. When I invest my money in real estate, I do not invest my money for appreciation because that's unpredictable. If I bought a property today for $200,000, I have no idea what it's going to be worth 12 months from now. Sure, I can make predictions, but the market could crash, the economy could crash, the economy could boom, the Fed could change interest rates, a pandemic could hit. A lot of things can happen, and that creates a lot of uncertainty in the appreciation of a property. So I don't like buying a property with the hopes of trying to sell it for profit, because if I'm doing that, now I'm trying to make my money based off of hope, and I don't like doing that. So when I invest my money in real estate, what I'm looking for is cash flow. Those are the numbers that I make my decisions off of. I want to be in a good neighborhood where the population's growing, where businesses are moving in. That way I can see the most appreciation. I mean, appreciation is nice, but I look at that like the icing on the cake. I don't make my decisions based off of the future potential value of a property. I make my decisions based off of how much cash flow can I generate, because that's much easier to calculate, that's much easier to predict. Now, the cash flow that you're going to generate, the returns that you're going to get are going to depend on the economy, and it's also going to depend on the area which you're investing. Like back 10 some years ago when I started investing my money in real estate in the Metro Detroit area, because, well, we're in Detroit, I was turning down deals that were making a 15 to 20% cash on cash return because those were not good enough deals at that time. Back in that time in 2011, 2012, 2013, if a property was not making 20+%, it wasn't worth my investment. Now, I was not a very sophisticated investor back then because I had no idea what the heck I was doing, but what I knew and the math that I was doing was if a property cost me $50,000, I want to get my money back in 4 years. Then the market started to change around 2015, 2016, 2017, and then again in 2020, 2021, 2022, 2023, 2024. And now, what I look for when I go out and invest my money in real estate is a 7% cash on cash return. Meaning for every dollar that I invest, I'm looking for 7 cents worth of cash flow, worth of profit from my real estate investment. Now, again, this cash flow is going to vary neighborhood by neighborhood. If you're in Manhattan, you are not going to find a 7% cash on cash return. You're looking for a 1% cash on cash return. So if you invest $1 million, you're trying to make $10,000 a year of profit. So neighborhoods across the country are very different, but what I'm looking for is growing populations, growing business areas, nice neighborhoods where I can get the 7% cash on cash return. And yes, this does exist today. Now, that might mean that you have to look outside of California. That might mean you have to look outside of Miami. That might mean you have to look out the area that you're in. But let me tell you something. Detroit is a great place to live. Metro Detroit is a great place to be. And so, well, this is a little pitch for Michigan. But here's what the numbers look like. Now, in the beginning of this video, I showed you that $100,000 property that Zillow says would rent for around $1,500 a month. But let me give you kind of that typical property that you're seeing nowadays, which I would consider a pretty decent return. You buy a property for around $165,000, and then it probably will need a little bit of work because I like to have my rental properties be nice and kind of that top of the market in terms of the quality of the property. So even if it's in really good condition at $165,000, I'm still probably going to put in another $15,000 worth of work, meaning my total cost in this property is $180,000. Let me try this black marker. This is starting to fade on me. Oh yeah, there we go. $180,000 cost to buy the property. Now at $180,000, I would want to rent this property for at least $1,800 a month, if not $1,850 or $1,900 a month, depending on the area. So let's assume now you're renting this for $1,800 a month, and yes, you will be able to rent this out all day and night long at $1,800 a month for this property in good condition, in a good area with growing populations and growing business. From here, you got to subtract your expenses, big things like your property taxes, your insurance, your maintenance, your management, because I am not going to manage the properties myself, and then any other fees that you might have coming up, and your mortgage if you're going to go out and take a mortgage. So let's assume now, for the purposes of this example on the first part, that you're doing this deal all cash, that you're not getting a mortgage, because as we know, mortgage rates are more expensive. So let's assume right now, we'll talk about mortgage in just a second, that you're buying this property all cash. That way we can do a fair assessment of the types of returns you'd get on your cash investment, assuming you bought this property without any debt. So if we just put some rough numbers on this, people like to call this the back of the envelope or back of the napkin numbers, because these are just super rough numbers. If we say $180 a month for property taxes, another $150 a month for your property insurance, another $150 a month for your maintenance, and hopefully it'll be less, especially for the first couple of years, because, well, I want to make sure this property is in tip-top shape, so hopefully very little maintenance, but let's just assume $150 a month in maintenance, and then another $150 a month in management fees, because you should be able to get a property manager for around 8%. This leaves you with $1,170 a month in profit, assuming that you bought this property all cash. Now, what type of return does that mean? I had to pull up my calculator for this one. So now, if we take $1,170 and we multiply this by 12, that means your annual income after this property is renovated, after you get a tenant in there, is $14,040 a year. That is your annual projected income. Might be a little bit more, might be a little bit less, but just a kind of rough idea. Now, if we take this $14,040 and you divide it by the $180,000 you had to invest to get this property, this is a 7.8% cash on cash return. Meaning if you put in $180,000, you're getting 7.8% in yield from your cash flow. We're not talking anything about appreciation. If this property goes up in value, that's the icing on the cake. If it goes down in value, oh well, you're still getting the 7.8% yield on the cash that you're investing based off of these numbers. Now, of course, there are variables. You could get a bad tenant. The tenant could destroy your property. You can get a bad property manager. I've dealt with all those things, but this is kind of that ideal number now where this property now makes sense to consider investing in. Now, if you don't have $180,000 saved up to go and buy this property all cash, what happens if you get a mortgage? Well, let's run through those numbers. Let's assume that you put down 25% in equity, 25% down, because I'm not a fan of over-leveraging, because over-leveraging can be very dangerous, and it's also very profitable for the people that are buying your deals after you get foreclosed on because you took on too much debt. That's how I found some of the best deals that I've invested in. It's somebody who goes on, takes on way too much debt, they don't know what they're doing, and then they get foreclosed on, and the bank has to sell your property for pennies on the dollar. So let's assume you put 25% down. That means that you are going to be financing $135,000. This is the mortgage side. So you finance $135,000. Let's assume that you get a 7.5% interest rate because, well, interest rates are higher now than they were a few years ago. That means your monthly mortgage payment on this is going to be $944 a month. Now, again, you're making $1,170 a month after expenses before your mortgage. That means net you're making, had to get my calculator again because there's a lot of pressure when you're watching me on YouTube, but that means you're making $226 a month after paying your mortgage payment. Now, what does this mean in terms of your return on the cash that you invested? So now, you take this $226 and multiply it by 12. That means that you are making about $2,712 a month, assuming everything goes well, which, yes, of course, it is an assumption, but you got to run your numbers based off of something. So, you're making $2,712 a year, not a month. You're making $2,712 a year from your income from this property after your mortgage. I told you, YouTube puts a lot of pressure on you. Now, how much money did you invest? You bought the property for $180,000. You borrowed $135,000, which means you put down $45,000 yourself. So now, if you take this $2,712 and you divide it by the $45,000 that you had to invest out of your own pocket, that means you are getting a 6% cash on cash return on your money here, because you put down $45,000. This $2,712 a year that you're making is a 6% yield, dividend, rental income, cash flow, whatever you want to put on it. It's a 6% cash on cash return of money that you're getting based off of the $45,000 that you invest. Again, this is focused solely on the cash flow, but then on top of this, you also get your tax breaks, because remember, you get your depreciation deduction. So you get to also pay less money in taxes. In this instance, you'll probably be paying no money in taxes on your rental income, because again, if you do the depreciation deduction on a $180,000 home, you subtract the land value, then you take the property value, divide it by 27.5. Well, you're probably gonna have a loss on paper. Now, you have cash in the bank, you made a profit in terms of how much money you made, but when you report it to the IRS, you're showing them a loss, which can be carried forward. So if you start making bigger profits in the future, you still get to pay no taxes because you can carry forward that loss. Here, if you're making, what, $14,000 a year, you're probably still going to be paying taxes, but it's going to be a lower amount because you get the depreciation deduction. So this is where now, if you're thinking about investing your money in real estate, what you need to be looking for is what types of deals that you're looking for, where are you finding these properties, and what types of numbers are you looking for. For me, I like investing my money in cash flow producing real estate, because now I can just keep stacking the cash flow. Buy a property every year and just keep stacking the cash flow year after year after year. That way the cash flow keeps increasing, and if property values go up, that's icing on the cake. If property values go down, oh well, I like to have margin here, that's 7% return, because if we see an economic slowdown, I can also then have the ability to potentially reduce my rents if necessary and keep this property producing income. So this is where now, if you want to invest your money in real estate, great. Just make sure now you understand there are risks with investing your money in real estate. You have the economic risks. We could see a recession tomorrow. We could see an influx of foreclosures. Although there's a lot of kind of unique factors right now kind of preventing that, but I'm just talking about the hypothetical. When you're investing in real estate, you have the risk of bad tenants. You have the risk of a bad property. You have the risk of a bad property manager. But if you invest in real estate and you take on those risks, you also get the upside. The upside is you can get the appreciation. The upside is you could take the depreciation. The upside is you can get some of the tax benefits. The upside is, well, you can flip this property in a few years if you see the appreciation, and also not pay any taxes on the income. So there's a lot of benefits to investing in money in real estate. Not everybody should be investing their money in real estate, but for those of you who are thinking about investing your money in real estate, it can be a great opportunity for people that can handle the risk and that are willing to put in the work, because it is a lot of work, especially in the beginning. Once you get past the hump, well, then it can be completely passive on your side when you have a good management team, but you got to put in the work to build that team in the first place. And again, I have my free workshop where if you'd like to learn more, the link is free down in the description below. This is from Greg McBride, who's the Chief Financial Analyst at Bankrate. And what he says is, if you get that promotion in 2024, you pay off your student loan debt, you really build up your savings, you're going to be in a position where home prices may not be much different 2 years from now than they are today, but your financial position is a whole lot better. Now, if you're confused,